Hey, good afternoon, everybody. Chris Lester here. I'm going to be your presenter and host again this week. So we're going to go ahead and get started on time. Here we are, a week away from Christmas, and COVID is still prevalent. So what we've done is in an effort to bring quality content education to the community, to our clients, and to folks that are working with our group. We have advisors all over the country, and we have a holistic approach. What we're trying to do is bring valuable information, market update, could be product specific, could be theory, and with that, you can make good informed decisions as you go forward. Remember that these market updates are a snapshot of the month before. So because last week we did something on is the sky falling, or a contrarian update, I felt it appropriate to sort of follow up with, let's take a look at the markets in general. First thing I want to say is that the markets today for indices all closed at their all-time highs ever, right? So the S&P, right, which are your blue chip stocks. You have the Dow, the industrial averages. You have the NASDAQ, which is your tech sector, and then you have your Russell 2000. All four of these indices hit all-time highs today. Now, we want everybody on this call to make money. But you may recall that I had a slide at the beginning of the year, Warren Buffett, and Warren Buffett's rule of investing. Rule number one is don't lose money. So we're going to go over the indices in general, and a market update for December 2020. And this is a snapshot of the month of November. And as we go left to right for the month, you can see that these indices, and I'm going to go through the colored lines, but overall, most of the indices had a positive month, and handsomely so, right? I mean, if you recall, November 3rd was the election, and you can see that right after the election, that most indices started an upward trend to the right. That was led by the blue line, which the Russell 2000 is small caps or small business owners, 18% on the month. So there was a rally to the private sector, to the small business community to say, hey, things are going to be okay. And that's where a lot of bets were being made. Then you see the next line down, a little further down, is that green line, that neon green line. This is developed countries, right? So, 21 developed countries throughout the world, and also did well. So this is not in the US, but people were betting in recoveries in other countries, namely Europe, and also did handsomely well, with a 14% return. Now, the teal blue line there, that's your commodities. And this was a little timely because, the commodity sector is made up predominantly of oil. And oil has gotten the snot kicked out of it this year. So to have a good month in November, I think was welcome news to people that were betting on that index. And then the next one is the one that we all hear about that is, again, closed at all-time highs today, is the S&P 500. And that is namely your blue chips. But the thing that I point out here is that the S&P 500 is price-weighted index, and it's made up of predominantly 5 stocks right now. So your Googles, your Facebooks, your Amazon, your Netflix, they're carrying the lion's share of this index. So, out of hundreds and hundreds of blue chip stocks, they're really being carried by a small select few. Now, the black line is Vanguard Real Estate. So think of REITs, right? The one thing I will say is, although, this made a little bit of a recovery for the month, I'm just hearing, more and more stories of commercial real estates where tenants just can't pay their obligation, right? So whether it be restaurants or small businesses. So although small businesses had a good month, right, betting on commercial real estate would not be something where I would bet my chips, although that month, for the month of November did very well. And then the last one is emerging markets. That's that bright pink line, still above 8%, and that's your predominantly China, Asian countries, and anybody that's looking to develop their government. Now, the last one before we go to the next page, which had been leading the pack, notice that for the month of November, gold is actually down about 5%. Now, remember that gold is traditionally considered a flight to safety. And the reason I'm pointing some of this out is just think about what the slides we talked about last week is that contrarian theory says when everybody else is betting that things are going to go north, right? There might be some wisdom in taking some chips off the table. If you weren't on the call last week, I had a slide where it's called the shoe shine boy indicator. Maybe you've heard the story, maybe you haven't, but basically Joe Kennedy was getting his shoe shined on the streets, and when the shoe shine boy gave him a stock tip on something that he owned, he went upstairs and not only sold it but shorted it, all his holdings, and he made millions and millions of dollars. Because he felt that that was now at market saturation and it was time to get out and bet against where everybody else was going. And that's what a predominantly contrarian means. I'm not giving investment advice here. I'm just telling you that, hey, listen, we all want the market to go up, but if it can't continue to go north without substance. So let's look at what this year brought us. This is a year snapshot. Now being at the end of the year, we're 2 weeks away from the end of the year, but wrapping up November, you can see where COVID hit in March and everything went down except gold. But notice that with gold at the top of the chart in August, it was almost 30% because that's a flight to safety. That's where people, when they feel like, hey, listen, if the markets are going to crash and everything's going to go south, I want safe money. And people will look to gold indexes and things of that nature. But since, August, it's almost down 15%. So, people, if you got in August saying, hey, August was, gold's going up and the economy and the elections coming. There's a lot of speculation. Notice that if you had gotten in at the high, you would have lost 15% to where it is now. But it's still on the year. It's still north of where it started by 15%. Now the next line, and again, now that's the S&P. Again, it closed at all-time highs. Remember, it was down almost 30% in March. So, this is when everybody was like panic, COVID news is coming out. People are being told, stay home. We're in lockdown, we're in a pandemic. And as this news was coming out, everything took a bath. The next two are, again, emerging markets and the Russells, the small caps. Again, small caps got snookered. And then as things have slowly gotten better, they're grinding. And I do believe that, small businesses are the lifeblood of this country, and we have to help them in any way that we can. So instead of a lot of the big chains, your local restaurants, your local hardware stores, maybe it's if you're able to go to the gym or some type of boutique at a strip mall, they need your business. So think about where you're directing your revenue to be able to support them, because they're going to be the people that drag us out and through this. And then the neon green, now again, that's developed countries are just above even for the year. So the rest of the world is not necessarily as profitable as the U.S. And then REITs. So this is where I'm cautioning, real estate, although we had a good month for the month of November, people are just not able to pay their rent. And if you're, looking at real estate as an investment, right now would not be a time that I think it would be a good investment choice. So timing is off, in my opinion. And they're down almost 30% of the year is oil. So the airline industries, the cruise industries, anybody that's relying on, this index or commodities, which is predominantly weighted in oil for the year, is down. So, this is just as we're, you hear on the news, and this is why I always caution that everything on the news is either gloom and doom or it's rosy and everything's all-time highs. Well, all-time highs are on this chart are only two of the indexes, the S&P and the Russell, right? The Dow's not on here and the Nasdaq's not on here. There are a lot of indexes that make up the economies in the different, in not only in the U.S. but in different countries as well. So this is called our bull bear indicator. There's a lot going on here, but it's not overly complex. As we look at this, there are three indicators in the upper right hand corner. This is called your relative strength index, your RSI. Then we have our moving average, and then we have our MACD, which is moving average crossover divergence, convergence divergence. And these are just, we call it the three wise men. Basically, they're just signals. So if we were in a plane and you have three indicators on your plane in the cockpit, and one is telling you the wind speed outside, and one's telling you radar is coming up into the direction that you're heading, and maybe the other one is telling you your altitude. Think of it like that, right? So when we look at this, they are not by any means just what we should base our bets on, but they're just indicators of what we're experiencing right now. So the red line means that all three of these indicators went negative. And if that happens, a red line is created. And typically it means that we may be, if a red line is triggered, we may be heading into a recession or a downward trend. Now, the green line means that all three indicators now went positive, and it should be an upward trend like happened 2003 to 2006, 2007. But notice right here, we got a head fake, right? The indicators went negative, but then they still turned around and continued north. And that's why we say it's not always perfect. But then 2008 happened, and this was the housing bubble burst. And then it wasn't until, almost 2010 that the market indicator said, hey, it's okay to get back in. And then we said, hey, now we've been on a, almost a 10-year bull run here, right? Now we had a negative indicator, sort of a sideward pattern. And here's where I point this out. In March, we had a trigger that basically said, hey, listen, the sky is falling, things are bad. But it was a head fake, right? And a lot of my clients, I sent out emails and I said, listen, we think, and a lot of the economists feel, this is a short-term downward trend. It was one of the quickest downward trends ever in history. And we think that by the fall, things should recover. So one of the technologies that we use as Wealth Guard may have triggered and moved people to cash. And I gave a lot of the clients the ability to say, hey, if you want to override that technology, then we can go ahead and move you back into an asset allocation that like you were initially. And I think the people that pulled that trigger and made that move have done well with that advice, right? Because we've seen this continued upward trend, and that's why we've hit all-time highs. And we are actually now, right, almost back to where we were with a lot of the accounts. Because remember, not every account was in, say, the S&P or things of that nature. I only point that out to you. So as you're listening to the news, as you're trying to make decisions, as you're hearing noise on the radio or from a coworker or what I call the water cooler expert, you have to temper that by saying, what is their source of information and how are they reacting? So that's on the equity side of it, the bull bear indicator in the S&P 500. So now the income markets, right? Again, this is for people that are saying, hey, I want, if you're looking at your asset allocation, you go, I'm 60% equities and 40% bonds. The 40%, that's this side of the equation. And I want you to see for the month of November that every indice was positive. So November was a good month. And again, after November 3rd, there was absolute upward trend. Now there was a little bit of speculation in the teal blue. The 20-year treasury did dip because, again, remember, people will go to safety, which are treasury bills, treasury bonds, right? So either the 7 to 10, which are the neon green, or the light blue for safety if they think that things are uncertain for the future, just like gold. But when you look at the top of the chart, when we look at the return for the month over 3%, notice it's high yield corporate bonds. So that blue line, high yield, when you hear that, you should substitute that word for junk, right? That means at above average risk. So when corporations are offering above average rates of return, right, in order to produce yield, right, that there is more risk than, say, other investments. And that brings me to the point that I wanted to say is that we have to be careful right now because everybody is on a hunt for yield. And you'll see in the next slide why this is such almost an anomaly for the month of November. Now, the next one down, which is that green, is a high yield muni bond. So, the first one is corporate. The second is governmental. So your local community here in New Jersey or across the country, high yield, or in other words, junk government bonds, right? And then we turn around, the next two are pretty close. And those were the 20-year treasuries and the normal muni bonds, right? And then you have the red, which is now we're into the US market, which is the aggregate bond markets for corporations here in the New Jersey, I'm sorry, in the United States. But it's just, more of your traditional paper. And you can see that the yield is almost half of what the high yield corporations might be paying. So therefore less risk. And those are usually your blue chips that are issuing those types of bonds. The last two on the page, again, are your Vanguard Total International bonds, and then your 7-year treasuries, which are as safe as you're going to get, right? So now when we put a snapshot of how did the year look, well, that brings me back to my statement on the previous slide. The top two, there was a flight to safety come March, which was everybody went into the 7-year to 10-year treasuries or the 20-year or gold. And that's why it's done so well. Is this where our money should be in the future? I don't know. But the reason it's done so well is because people are uncertain. And then as we continue on down, yield, it will be a continued pursuit as we move through 2021. People that have now retired and need to get, most pensions were originally designed with 6% on their money, and now they're having to dial back to 3%. How are we going to generate 3 to 4% safely to meet their contractual obligations? So, this here just shows you that the income market as a whole, right, is challenged. It got spanked in March, but right now people feel like, okay, it's recovered. But again, back to our contrarian theory is if everybody is thinking that the sky is rosy or we're looking through rose-colored lenses, I just caution, and this is why last week, I'm not saying that we should move all the cash. What I am saying is that we should maybe take a little bit of the equity exposure and move it to cash or to equity or to bonds for a safer position so that we don't break rule number one, which is lose money or minimize that downward trend. We can't time the market. We can't predict what it's going to do, but we can think and look at warning signs and signals, just like I was talking about airplane indicators. And this is where using tactical money managers comes into play, or having oversight from a financial advisor helps you to make good decisions, think it through, even if it's short term, right? So it's only, hey, 1, 2, 3 months, we get through the holidays. Let's see what 2021 looks like. And this is why I said, to a lot of our clients, we've said, let's just keep 20% in cash right now so that when the market does, correct it, you're in a position to step in and buy low. So that's where that comes into play. And then the bull bond indicator here for aggregate bonds, you'll look and it's the same thing. And then now as I come all the way to the right, we have a green line. And we have been on an upward trend. So this is good news. And I don't want to buck a trend, right? So we need to be in there. We need to be diversified. We need to be wise. But I ran across a client just recently that had, when we went back and looked, they had, through their work, 80% exposure to equity. And I just said, look, it's your money. I just would caution in saying some of what I'm seeing, dial back your risk. If you want to step back in and dial it up later as we start to see where, 2021, develops, fine. But I think right now, a lot of weight is being placed on the stimulus, right? So now we have, added relief being offered to these small business owners, trying to get money into their hands so that they can stay afloat. And then you also have, the vaccine, right? So, but once those two, realities work their ways through the market, what's left? Who's still in business? How many jobs are lost during this, right? So this is why I just be careful what you hear in the news, the talking heads, what everybody at the water cooler is talking about, the so-called guru or expert. You have to just sort of take a step back after you've looked at the data and apply something that's not so common, which is common sense, right? So let's take a measured approach to how to be in the market to get gains without giving back our gains once we get it. Now, this last indicator, this was actually good news, right? So this is called the recession probability analytics. This is a proprietary tool that was created by Formula Folios and now part of Brookstone. And basically what it's saying is out of 100 indicators, they assign a value from 0 to 100, and anything over 50, right, means that there could be a probability of a recession. And this is measuring things like, hey, what is the gross domestic product? What is unemployment rates? It's taking all of these, assigning a value, runs it through a calculation, and then it just measures. And if we're on the bottom side of the line, right, that's actually good news. So the fact that we're gone from 38.43 last month down to 28.74 now, it means that right now the flags on the poll are signifying that a further recession is not a risk at this time. So then you're saying, well, Chris, what is it? You said last week, there are indicators that are predicting that, most times people are wrong. And then this indicator for this month is saying things are smooth sailing. And this is the challenge. If I had a crystal ball, I'd be a very, very wealthy man. I'd be Warren Buffett. But I don't. All I can do is bring you the data. All you can do is make good, solid decisions and have strategies, right? We don't want to use knee-jerk reactions. We don't want to use emotions. What we want to do is be consistent. Let's go into it with a plan. The plan sometimes works, sometimes it doesn't, but consistency and averages can work to your favor. So again, that's what our role here is. Professional planning services is to help manage expectations, help you to think about what the decisions you're trying to make. The last thing I want to talk about is, I'm not afraid to say it, Merry Christmas. I want to wish each and every one of you on this call, I want to thank you for taking time out and joining us each and every week this year. From my family to your family, we want to wish you a Merry Christmas and a Happy New Year. This is our last call of 2020. 2020 has been a tough year for a lot of people. But we as Americans, as Warren Buffett has said, I'm betting on America. We will get through this. We have to be diligent. We have to be patient. But at the end of the day, we will be stronger and better for it. But right now, during the holidays, things are different. You're going to have smaller gatherings. Hug the ones you're with. Tell them you love them. Tell them how much they matter. And let them know that you're here if they need you. And that is my last thing I'll leave you with. If anybody on this call needs anything for any reason, and it's within my power, I will help you out. Maybe you can't get to the grocery store. Maybe the snow, you need to have your driveway shoveled. I will come help, or I will make arrangements to come help you get it done, right? We are a community. We need to help each other. I got your back. Don't keep us a secret, and anything we can do, God bless you. This is my CYA. All right, it says everything I just said is my opinion. And then lastly is if you have any questions for us or anybody of the advisors that invited you on, please make sure you reach out to them or to us. And again, I want to thank each and every one of you from the bottom of our hearts. Merry Christmas. Thank you. See you all in 2021. We're going to have an open mic on the first week, and it's basically going to say, hey, ask the financial planner, ask the financial advisor, which is me. So, don't try and stump me, because I'm going to tell you my de facto answer. If I don't know the answer, is I'm going to research it and get back to you. But if you've got a genuine question and something that you'd be interested in, that's what we're going to do at the beginning of the year and start the new year off from there. So again, Merry Christmas to everybody. Thank you for joining us and have a great day. Bye-bye.